This is Colin Cattell with Palisade Radio, and here on the line with us today is Paul Van Eeden, president of Cranberry Capital. Paul, thanks so much for being with us today.
My pleasure.
Paul, gold has taken quite a hit over the past few months, and I have to give you credit for being one of the few guys in the gold arena over the past year or two that was saying gold's overpriced. What do you believe the current fair market value of gold is today, and are we still a bit overpriced?
I think we're still quite substantially overpriced. So I think there's a lot of downside risk to the gold price, and I think the fair market value is probably somewhere around $950 to $1,000 an ounce.
Can you talk to me a little bit about the metrics that you use to determine what the price of gold should be in dollars?
Yes. So basically, I view gold as money. I'm a gold buck. I'm just not always a gold bull. But I do believe that gold is a currency and it's money. And if gold is money, then we can evaluate the value of gold vis-a-vis other currencies such as the US dollar by comparing their relative inflation rates. And I compare the changes in inflation between gold and the US dollar going back to the year 1900. And based on the relative increase in the amount of dollars over the last, call it 113 years, and the relative increase in the amount of gold over the same period, I come up with what I call a theoretical exchange rate or a theoretical value for gold vis-a-vis the US dollar. And at the moment, I think that comes in at around, as I said, around $950 to $1,000 an ounce.
And along those same lines, you've developed a tool called the actual money supply. And how does the actual money supply differ from other metrics already in place like M1, M2, and so on in determining inflation?
Oh, that's a very good question, because most people just refer to the standard monetary aggregates, and typically the M series. But if you look and think about the M series, for example, M1 includes demand deposit accounts at banks, but it doesn't include savings deposits. Now, I've never met anybody who believes that the money that they deposit in a savings deposit in the bank is no longer theirs or simply evaporated. Most people in the world consider the money that they have in savings account to still be their money and still be there, and they act as if it's there. So clearly M1 isn't a good measure of the actual money supply because it disregards all savings accounts. M2 counts savings accounts, but only up to $100,000, and the same problem exists. If you count savings accounts up to $100,000, does that mean if I deposit $1 million that I actually only have $100,000? Well, no, it doesn't. So M2 doesn't work because it doesn't count all the savings deposits. It only accounts the small savings deposits. M3 counts large deposits as well, but both M2 and M3 double count money because they also include money market mutual funds. Well, money market mutual funds are assets, they're not money. And the reason, it's very simple to see why you can't count mutual fund certificates as money. If you buy $1 million worth of a money market mutual fund, then the mutual fund company takes the $1 million and buys $1 million worth of short-term debt from a corporation, and the corporation deposits the $1 million into its bank account, and we count the money in the bank account. You can't now also count the mutual fund certificate because now you're double counting the same $1 million. So M1 doesn't count all the money, M2 doesn't count all the money, and both M2 and M3 double count some money. And in fact, the double counting in M3 is so large that at any given time, depending on movements in and out of short-term mutual funds, short-term money market funds, the double counting in M3 can be a third to a half of its value. So it's an enormous amount of double counting in the case of M3. The bottom line is that there is no standard monetary aggregate that actually counts the money supply in the Federal Reserve banking system in a logical manner, which is why I created this aggregate that I call the actual money supply, which counts all the notes and coins in circulation. I think most of us would agree that notes and coins in circulation should be part of the money supply. And it counts all the money at all the commercial bank accounts, both demand deposits and savings deposits, but it doesn't count anything else. So I've yet to meet anybody who can tell me what else is money or what I'm counting as money and isn't money and give me a good reason why.
So there's been a significant amount of fear of inflation because of quantitative easing. However, looking at your metric, the inflation actually hasn't really hit the system that much. Why is that? Why isn't the money actually going into circulation?
Well, of course, some of the money does go into circulation, but you have to keep in mind that it's not as simple an equation as what some people make it out to be. What I'm looking at here is the actual change in the functional money supply in the US Federal Reserve System. In other words, the money that's available to us to use. I'm not looking just at changes in the Reserve Bank balance sheet. If the Reserve Bank balance sheet grows or shrinks, those changes can be captured in the reserve accounts, which commercial banks have at the reserve account, at the Reserve Bank. But those deposits that commercial banks have at the Reserve Bank are not available to the commercial banks to spend, nor are they available to me or you or anybody else in the economy. They're banking accounting entries. So we need to look at the actual change in the functional money supply to see what the effect has been of quantitative easing on the actual money supply. And that is, as you mentioned, on my website. And as you can see, there has been tremendous changes in the inflation rate. But we're not looking at runaway inflation. I mean, there's no sign here of hyperinflation. There's no sign of monetary inflation getting ridiculously out of hand. In fact, it appears, over 2013 as if there's been a consistent decline in monetary inflation, in the inflation rate. I shouldn't say in inflation, but in the inflation rate. So what happened in the gold market is when quantitative easing was introduced back in 2008, 2009, the gold market took off in anticipation of massive amounts of monetary inflation, but that never materialized. And the kind of speculation ran on until it became clear that we might be nearing the end of quantitative easing. So as soon as the Reserve Bank sentiment shifted from unbridled easing to the possibility of restrained easing, the gold price started to turn around and go down. And that's the phase of the market that we're in. This whole speculation about runaway inflation, in my opinion, is one, overdone, and two, it's over. That phase is over. So we are slowly getting the gold price to come back towards a more realistic level, which in my opinion is around $1,000 an ounce. So I don't think that the decline in the gold market is over yet.
And switching gears just a little bit, your interest in the gold sector as an investor, you've stated, is focused on the junior sector. Why have you chosen to focus on the junior sector in particular?
I've been investing in juniors for almost 20 years. It's just something I do and I know how to do it. So if you will, it's my trade, it's what I do. The reason I do it is because there are phenomenal gains to be made, but there are substantial losses to be had as well. So you have to be careful. I've been fortunate over the last 20 years in that my gains exceeded my losses, but it's a very risky business. The nice thing about the juniors and the exploration companies specifically is that the ones I invest in have nothing. And if they have nothing and they find something, you end up making money. The trick is to find the ones who have a better chance than most to find something. And, that's risky and easier said than done.
And one final question for you: in selecting juniors, is it a bit of a gut feeling that you get since you've been in the industry for 20 years when you identify a company that you go ahead and buy, or is there some sort of set system you use to identify the companies that you're going to invest in?
I rely a lot on people who are very good at evaluating early stage exploration projects. One person in particular that I rely a lot on is Brent Cook. Brent's seen a lot of projects and is very good at analyzing early stage projects. So I do use a lot of expertise from people who know how to do this in terms of looking at projects. But that's only a half of the equation. The other half of the equation is backing good people. And in these little companies who don't have much in the way of mineral assets or financial assets, the most important asset is the management. It's the people who run the company. So my basic methodology is just to invest in people in whom I have confidence and whom I trust, and give them time to ply their craft, which is making discoveries. And not all of them are fortunate enough to make a discovery, but as I said, it's a little bit of a numbers game. If you own a big enough portfolio of the right companies, you only need a few successes to give you a positive outcome overall.
Paul, thanks so much for sitting down, taking the time to be with us today. For any of our listeners that want to find out more information and learn about the all money supply and your metric for gold, where can they go to find out some more information?
The website is paulvaneeden.com, and the money supply measures that you talked about are on the website. They're updated every week, and the gold value calculation is also on the website. It's updated perhaps once a year because the valuation changes very, very slowly over time, but they're both on the website at paulvaneeden.com.
Great. Thanks so much, Paul.
Thanks, Colin. All the best.